what a lot of people forget, when they ultimately sold that portfolio, they lost $2 billion, which is certainly a lot of money for my company, Illuminate Advisory. But Silicon Valley Bank, they had 200 billion in assets under management. So losing 1% of your portfolio generally doesn't lead to the end of your business.
Welcome, James. Everybody, this is James Green, co-founder of Illuminate Advisory, as well as a resilience think tank. Welcome. Want to let you introduce yourself a little bit, and of course, you know the topic better than I do, so I'll let you start with that too.
Yeah, absolutely, Sarah. Thanks for having me back. For those of your audience that I may be new, my name is James Green. I am the co-founder of Illuminate Advisory, also one of the global co-founders of the Resilience Think Tank, and I'm based in Florida.
So not only do you deal with risk every day, but you're also, you have the hurricane risk and everything else going on down there.
Deal with hurricanes, we deal with gators. Florida man is here and strong, definitely.
Yeah,
Yes,
it's definitely that time
absolutely.
of the season. Yes. I even saw, I think it was Credit Union Times had a Florida man headline. I was like,
yeah, it wasn't me. I'll just say that. So.
Well, we're talking today a little bit about Silicon Valley Bank, and especially, there's a lot of different risks that come into play with that. From reputational, we were talking a little bit earlier about the federal government stepping in, and the I think I want to look at too the ESG risk model that they seem to be following. Maybe fell a little short on the governance piece. But yeah, talk a little bit about all the different risk factors that were involved here. And I think too, we'll get a little into it later on about, how credit unions can mitigate that for themselves, maybe on a smaller scale. But yeah, I'll let you go.
Yeah, this is certainly an interesting one to me, because I feel like the bank started in the right place. So Silicon Valley Bank recognized, okay, interest rates are at historic low. We're not getting the return on our deposits that we want. So let's move those some of those deposits into mortgage-backed securities. What a lot of people forget, when they ultimately sold that portfolio, they lost $2 billion, which is certainly a lot of money for my company, Illuminate Advisory. But Silicon Valley Bank, they had 200 billion in assets under management. So losing 1% of your portfolio generally doesn't lead to the end of your business. What I find really interesting from a crisis management perspective, I think you will see Harvard Business School studies on the press release that they released the week of the 10th, because by saying, hey, don't worry, we don't have liquidity issues, you don't ever say that unless you have liquidity issues. I have 2 teenage boys, and if they came home from the grocery store and said, hey, Dad, we didn't steal anything at the grocery store, what's the first thing I'm going to think? Like, that's such a bizarre thing to say. What did you steal? We got to return it back. So one, by having it, it really shows to me the power of crisis management. They inserted a line in that press release that was problematic at best, and probably resulted in a run at worst. And then you saw a lot of these tech executives who are always maybe not used to traditional banking and how banks work. There were these articles coming out that they had this huge text chain, a bunch of CEOs saying, hey, let's all pull our money out so none of us lose money. But as we know, or as you and I were talking before we went on screen, anyone who's ever watched It's a Wonderful Life knows if we all go and ask for our deposit at the same time, the bank fails. So certainly an interesting exercise for me in terms of crisis management, in terms of PR, huge PR miss. And I think there's an opportunity. A lot of companies are looking at this from a vendor risk management standpoint. You had a lot of payroll companies had all their money at SVP. So there was one, Patriot, I believe, had 55,000 companies. They kept all of their money at SVB, $100 million in March 10th payroll was at SVP. And if the FDIC wouldn't have stepped in, all of those companies' employees, tens of thousands of people, would not have been paid. And I've had a lot of credit unions and community banks talking to me the last few weeks about how do we look at our payroll providers from the lens of vendor risk management, because it had never occurred to them that these payroll companies may have concentration risk. And for most organizations, you have more cash with your payroll company than all of your other vendors combined. And if your employees didn't get paid on that Friday, they weren't going to care about a payroll processor, about a failed bank, about the FDIC. They're going to say, hey, I work for you. My check isn't there. You need to make me whole.
Mm-hmm. Yeah, I think that's a really interesting perspective, because that is something that I think, you just expect it to work, whatever it is, right? Especially as an employee or even as a credit union using whatever the service is. I'm paying for the service. It should at least provide that service. So yeah, definitely an interesting angle there too. One of the things that you talked about early on was also the communications. Yes, there may have been some missteps in SVB's press release that went out that you mentioned a bit ago. There's also this whole tight-knit community of fintechs that are on Twitter, on Slack, communicating with each other. And then I think there's another element too, where when the government did step in, or was deciding to step in, the Federal Reserve, Janet Yellen was speaking, the president was speaking. I believe in a lot of open communication, but I wonder too if all that communication, especially among a lot of people who didn't really know what was going on, like the fintech community necessarily, was almost created a bad communication. There was a lot of risk inserted there because of all the communication. Even like as a individual consumer, the president is on TV talking about this. Should I be worried? So I think there's a lot of stuff around that. So yeah, talk a little bit about the communications risk.
Yeah, that's really tricky, because the government looked at what happened in 2008. Okay, we let Lehman fail because it was their fault. And then the whole system not collapse, but we had our biggest recession since the Great Depression. So thankfully, the government this time said, okay, we can't let that happen again. You saw the markets were down, especially in the financial sector, 10 to 15% in hours on that last Friday. So they want to step in. They want to reassure everyone that everything's okay. But again, the irony is, again, going back to our grocery store analogy, if you and I are on an airplane and we're flying from Boston to Tampa, and the flight attendants are walking through the aisles and say, hey, everything's okay, don't worry, we're worrying. So you have to, it's kind of you're in a no-win situation where you want to show the public we are involved, we are being proactive, just like any crisis. But to your point, the president comes on, Yellen comes on, these people who are speaking about individual companies, people started to get concerns. And that's why there were ripple effects. So Credit Suisse has had problems for years, right? They had a scandal where they all got in trouble for spying. There was so many things happening there that they were in a precarious position, in my opinion, for 4 or 5 years. Just the wave of discontent and concern in the financial sector tipped them over. So.
Mm-hmm. And so one of the things I was looking up, but before the housing crisis, which you mentioned, there was a law, Glass-Steagall, that separated commercial and investment banking.
Correct.
That repealed, and since that was repealed, we've now had the housing crisis as well as this situation. Do you think that would have helped?
Absolutely. We saw a lot of protections created after the Great Depression. The SEC, there were all these checks and balances put into place so that we would never have a bank run again internationally. So we would never have a Great Depression. Those, a lot were rolled back. We saw what happened in 2008 as a result of that. And then there were some more banking laws put in. Those laws were repealed under the previous administration. And certainly, time and time again, we find certain financial institutions and certain organizations are going to play right up to that line of legal and in that gray area. And it gives them no margin for error. And now you're probably going to see, now we're going to tighten everything up, I think, again, because people have realized, okay, because of what happened at Silicon Valley Bank, unrelated but tenuously connected, Signature Bank failed. Credit Suisse dived. The markets dived. Like, it could have been worse than it was, and investors are still skittish. Reading now, the Fed's considering raising the rate again, which I think will concern some people. So you have all these entities now that are kind of interconnected, and some of these regulations I think are designed to protect these too big to fail banks from themselves, really.
Yeah. And to that point, if the Fed or FDIC is going to run in and provide deposit insurance, provide emergency liquidity, regardless of what's going on, regardless of the $250,000 cap on deposits, for example, what is the point of having a cap?
Correct.
And two, there is this moral hazard where if I'm the CEO of a large bank and I know my ass is covered, why not do whatever I can to increase the revenue, increase the profitability, increase the loans, increase the, whatever it is that my comp is tied to. And I know I'm covered, so why not?
Yeah. And I think you're going to see some new regulations be proposed around venture capital money. There's been a lot of stories and publications the last week that certain venture capital companies, if you receive funding, Series A, Series B, whatever, they required you to have all of it at SVB. So there's been a lot of commentary like, why didn't some of these Silicon Valley companies spread their investments or their deposits? They were required to put it in one place, and that's problematic because, to your point, there's a lot of people talking, okay, so we had a 3-year pandemic, your average US family got two $600 stipends, right? And SVP covered $80 billion in uninsured deposits in 72 hours. The system can certainly move fast when it needs to. And I think, you see people say, hey, I feel like banks and airlines get bailed out time and time again. And for the most part, they do. We can't not have a banking system. We can't not have airlines. But to your point, I think those executives know, even if they really screw up through ignorance or maliciousness, they always tend to get covered because they know what it would do to the global economy if they didn't.
Yeah, exactly. Interesting questions to ponder. So and all this stuff is all very nerdy, interesting, and I like that. I like that. Right now, I think just to kind of shift it a little toward the credit union market. One, credit unions are starting to get comfortable with working with fintechs. They're starting to, really dip their toes in there, and so. What should they be looking for? I mean, do they need to be researching their fintech's banking partners? And what should they be looking for when they're partnering with a fintech?
Absolutely. I mean, the federal government has said repeatedly to banks and credit unions, and I've said this for years, so it's not new. You can outsource process, you cannot outsource risk. So if you're using a payment provider or whoever you're using, you use a company to run your website, to run mobile banking, to run RDC, you name it, they go down, it's your problem. So you definitely need to know where their risks are and where their concentration risks are, because it may determine what you do with your members' money, with your deposit. You want to make sure that, just like they say in any investment, if you lose that investment, what is, can you survive? And we
Mhm.
should all be looking at, when we use fintechs, if one goes down, does our credit union go down? Like, how big is the pain point?
Mhm. And then the disclosures involved in that too. I mean, I think we've talked before on different subjects where credit unions sometimes don't even know or don't have access to their core processor's business continuity plan.
Yep.
So, like, I guess there are ways that credit unions might, build that kind of protection, those disclosures into the contract or through the proposal process.
Absolutely. The proposal process is the best time, and the second best time is at renewal. Because
Mhm.
in the middle of the contract, some cores or some fintechs or some companies may say, "Hey, we don't owe you that. It's not in the contract." And when does everybody want to please a customer? During renewal time. So if you don't do that on the front end, the best time is when you're discussing the renewal, put that language in there. We want to have access to whatever, business continuity, disaster recovery, enterprise risk, vendor risk management, everything you can get a hold of. That's the best time, because their salespeople will want to close that deal, and they will become your advocate and fight for you to get that information.
And financial risk.
Exactly.
Risk for sure. Um, and so one of the things that I saw a couple comments about on LinkedIn is, all these credit union executives are going out there, and community banks too. They're going out and saying, we're safe, secure, we do stress testing all the time, and that's well and good. And that's, great to assure that you're a stable financial institution. But on the flip side, there was a concentration at SVB because community
Mhm.
banks, credit unions won't do this kind of work. It's expensive, it's very specialized. And sometimes you see some credit unions buying banks for their, commercial business capacity. But what say you on credit unions getting a little more involved in the lending and maybe even funding through things like CMFG Ventures and groups like that that are funding some of these fintechs? How do credit unions get more involved safely?
I think for credit unions to continue to adapt and thrive, they need to be moving into non-traditional areas for credit unions that they're funding. But again, I'm not saying take 100% of your investments and put them in a new market or technology you're not familiar with, but start to get in there. Most credit unions can, like I said, lose 1%, 2%, and not even know it. SVP in a different scenario takes a 1% write down, and we're not even talking about this.
Mhm.
So the best way I find to understand a market is start to get into that market, but in a small way, so that worst case scenario, if that investment goes to zero, you're like, okay, well, we learned our lessons, but we haven't risked all of our members' money.
Right, and that was one of the situations at SVB too, was they literally bet the bank on long-term treasuries, making short-term loans, and 88%, I think it was, of deposits were not insured.
Yes.
So yeah, I mean, part of me is like, where were the regulators or the auditors or like,
Well, they weren't there. I've followed some fintech startup CEOs on Twitter, and it's been interesting. I was reading one today. They're now trying to find. They were with SVP B. They'd been there for 7 years. They're now trying to find a new bank, but they can't because they don't have a physical office in the US. That's a banking requirement that SVB missed completely. So certainly their due diligence was not where it should have been.
yeah. I mean, just, myself trying to get a business checking account, not a loan, no, like,
Yes.
just trying to get a checking account for the credit union connection at a credit union. I wanted to make sure it was at a credit union, but I had to jump through quite a few hoops because it was not a physical business, because it was
Yeah,
strictly online. Yeah.
myself as well. And I think that's very common with banks and credit unions. They tend to really scrutinize the small startups. So
Mm.
same thing with Illuminate Advisory. We are a virtual company. We travel. So to prove to them that we did exist and had to provide a bunch of paperwork to open a small account at the beginning. But you have a feeling if you come in with 7 or 8 figures of deposits, you would think the level of scrutiny would go up, but it's been my experience that it goes down
Yeah.
in order to try to win that business.
So as far as like the regulatory risk, what do you think, what do you foresee happening in the regulatory arena to again help stave off this kind of situation, which of course, even though Creighton's weren't involved, it will trickle down. So what do
Yeah,
you
there's always anytime there's a shudder in the financial system, the first thing is outcry, and the second thing is regulations. So there
Mhm.
will be regulations, good or bad. And since Sarbanes-Oxley over the last 25 years, they come and they go. So there's going to be definitely regulations, and it'll be interesting to see because it happened in California. California is a very aggressive state regulatory wise, so I would expect there's going to be California specific regulations that are new, and then probably us wide. So
Mhm.
it's going to be interesting. And usually the call for regulations is the most extreme right after the incident. It'll quiet down, but yeah, we definitely expect it's probably going to be more regulations again around investments or percentage of investments, or to your point, most likely percentage of uninsured deposits. A lot of these regulations, they seem to like these bright line tests because they're easy to audit. So I have 150 billion in deposits. I can have 10% of that uninsured or whatever, very easy, allegedly, to audit. So
Yeah, because that's one of the things. I think I heard credit unions 91% of deposits are insured. So
correct.
yeah, so definitely a very different pool we were playing in. Crane's, not a little more risk averse, a lot more risk
Yeah, of
averse.
course. Yeah.
And I think, one concern would be that Crane's gonna be like, yeah, we're safe because we did these things, and getting back to, okay, but can we dip the toe into the pool,
Yeah.
because
I'm
this
never a
is an
fan.
underserved market. It is.
Absolutely, because you do have true small businesses. You do have minority owned businesses. Historically, the credit union has been the lifeline to people who are underserved by the traditional banking system, and they are typically more conservative by design. I'm just never a fan of operating at the extreme. So if hedge funds are over here and your typical credit union's over here, I'm not saying become a hedge fund, but can we, if our from risk from 0 to 10, if we're at 0, can we go to 1 or 2? And I think our members will tolerate some losses in the interest of making sure the credit union stays relevant 10, 20 years from now.
Because what is the lost opportunity risk if you don't
Correct.
do it, right?
Correct.
And that's really being a good steward of the members' money.
Yeah, and that's how you encourage future deposits. I think that was one of the things that happened with Credit Suisse was, I think it was the Saudi National Fund said, hey, you had so much deposits pulled out last year. We're not going to put more cash in. We're done with that because you're not just your losses, but your deposits are shrinking. And that's problematic for any financial institution, especially a smaller credit union. Your deposits should not be shrinking. That really affects the long-term health of your organization.
What are the maybe what are the lessons that credit then can take away from this situation?
Again, to me, one of the biggest lessons is that you don't create a disaster from a disaster. And in this case, SVP's crisis communications are exactly what not to do. And this is why you should have a robust crisis communications plan. You should have people who write your press releases, who know what they're doing, who have experience in writing press releases and in writing crisis press releases, because there's a big difference between announcing your member give back annually and announcing a multi-billion-dollar loss. It's not the same skill set, shouldn't be the same writers. So I think certainly crisis communications are a huge lesson here. And then, like you said, when you try to outsmart the market of, okay, we've had historically low interest rates, they're going to stay that way forever. Nothing in our system stays where it is forever. So if you're betting on, like you said, these bonds and these T-bills and low interest rates, and you're making huge bets on that, or if you're making huge bets on short-term plays, that is truly a hedge fund type initiative. So we want credit unions to move into new spaces. We want them to explore new spaces. We want them to take risk. You don't bet the whole institution on risk. You take small risks so that if you lose, it's not catastrophic.
Yeah, and that's one of the things I know. I'm hearing a couple credit unions now that the board will set aside or ask the management to set aside a little bit of money just to play with, to experiment with, to make that small investment in whatever it is, so that it is controlled, but you do get the chance, the opportunity to make a difference.
Yeah, you define that risk appetite, those acceptable losses. So when a credit union provides car loans, they don't model 0% default.
Right.
That's unrealistic. They all have a percentage. Okay, this certain percentage of loans is going to default. We factor that in, and we're okay with that number. But I find a lot of times when credit unions start to look at, to them, what are considered alternative form of investments, they expect a 0% default rate. But you don't have zero with cars, and you don't have zeros with houses. So why are you expecting zeros in your other investments? Like you said, it's okay to have a number, because you're gonna win or lose as you understand a certain market and as you figure out where your risk appetite is for that particular market.
And having the policies in place and following them.
Yes, that is important. Following them is as important as having them. So
that governance piece kind of missing at SVP, but I think many the bulk of credit unions have a good handle on that.
Absolutely.
And the NCUA kind of makes sure of that too.
makes you.
I mean, I think, I've heard at times, that the NCUA is not maybe as sophisticated as some of the other regulators, but I can't imagine, allowing a credit union to get in this kind of, to scale this kind of situation. It's just,
yeah. I mean, I've worked with federal regulators through securities and banks for years now, and you do find the bigger the institution that's being audited, the more savvy the auditors because of scale. But to your point, if a credit union had $250 billion in deposits, they're not sending, like James just got out of college and he's worked for 3 months. That's not the auditor that's going to be on that account, certainly.
Yeah. Or the auditor who gets taken to a nice steak dinner and shown a good time and might, may not focus where they need to focus.
Correct.
Well, anyway, thank you, James, for joining me. I appreciate it. Always great insights from you. Any final parting words here?
You can find our company at illuminateadvisory.com. And like I said, I encourage credit unions to continue to explore new avenues of income and investment.
Yeah. If we have more credit unions invested just that little bit, distributing the risk, don't have a situation like this anymore. Credit unions to save the world. That's